Welcome to Selling a Business in a Leased Premises. The one we did last week, for those of you who joined us last week, we talked about how to help a buyer buy a business in a leased premises. And now we're going to talk about how to deal with the seller, how to list a business in a leased premises. I do believe that last week's video is now on our YouTube training channel. So if you did not join us for last week's, which was once again helping a buyer purchase a business, then please go to our YouTube training channel, and I'm sure it's there by now. Maybe it's another day or two. It's usually 4 or 5 days and it's there. So hopefully it's there by now. I haven't checked. This is listing a business. What you need to know to list a business in a leased premises. I do try to answer questions as they come up, so don't hesitate to unmute yourself, please, and talk away. Stop me and ask questions. I do also try to answer the chats. If you type something in the chat window, then I do try to get to those as they come up, so that we kind of deal with the subject at the same time that we're kind of talking about it. So don't hesitate to interrupt me or write me a chat if you have any questions. The more questions, the better. If Bob Marabi is still on board, don't ask me too many tough ones, Bob, please. So here we go. So some of the slides are pretty similar to what we talked about last week, but it basically is the same thing. So when you're selling a business and the seller is worried about the disclosure of financial information to a prospective buyer, you can inform them about the non-disclosure agreements, which is OREA Form 560. OREA Form 560 is sent to the cooperating agent, the buyer agent, and on it, it says who the buyer can share the information with that they will receive. So the buyer is going to receive some financial information, and who can he share it with? Generally, what it says is it says that it's shareable with his lawyer or his accountant, and that's about it. Sometimes, and it depends how you want to run your business, the cooperating agent is asking for financial statements. So sometimes what people do, what the listing agent does, is they send OREA Form 560 between brokerages, so that it says on the form that only the buyer of that agent can see it, and then that agent should have a confidentiality agreement with the buyer. So Form 560 can put a seller's mind to rest, because when the financial information is given to an agent or a buyer, the non-disclosure statements are treated very seriously by the courts. Buyers cannot go blabbing about financial information. If it would ever get back to the seller that they've done that, the seller could sue, and I think most of the time they would win. The non-disclosure agreements are very serious, so you can put your sellers' minds at rest if they have to reveal financial information. So that's Form 560. So financial statements. When a buyer wants to purchase a business, the big question is, what is the net operating income? That is the million-dollar question. Is this company profitable? And if it is profitable, how profitable is it? And so you want to try to get 3 years and average them. And we're going to talk a bit about the restaurant business, but I just had a phone call from another agent who's trying to sell a property that has 2 years of great financial information. And then 1 year, the COVID year, was really terrible. And so, you're going to have to judge that as you go because of COVID, especially in the hospitality industry. If there is no net operating income, how much is the business worth? Well, some buyers, some buyers will just buy. I mean, they've got great ideas. Maybe they can improve the menu. Maybe they can get a liquor license where there hasn't been a liquor license before, that kind of thing. But some buyers out there will just buy it because they love it. You know what? I've made muffins in my house all the time in my life. They're the best muffins. I've been told they're the best muffins in the world. And so now I want to buy a restaurant, and I'm going to sell those muffins in the restaurant, even if the net operating income stinks, because I know I can improve the business. That's called the love factor. And it certainly happens out there. There's no question about it. On the seller side, RICO Rule 567-05-21, the seller must have financial statements, fixtures and chattel lists, or a reason why not in writing. Okay, so if you're listing a property and you don't have financial statements, it's a cash business, and we do talk about cash businesses in a few minutes, and they don't have financial statements, or you know what, some sellers just simply don't want to give out financial statements, they need to inform you in writing that they will not release the financial statement. Okay, it's a RICO rule that sellers must have financial statements, or why not? Okay, same as lists for fixtures and chattels, they have to provide a list of fixtures and chattels, or if they're not providing one, why not? There are no fixtures included. There are no chattels included. It's a simple email to you guys as the listing agent for a sale of a business that you must have in writing financial statements, fixtures and chattels, or reasons why not. Don't forget, there's actually a court case out there right now where this exact problem has happened. The buyer had gone into a restaurant. It was full of tables and chairs and fridges and stoves. The agent, it's not our agent, thank goodness for this. The agent did not have a chattel list or a fixtures list. The buyer buys it, turns the key, walks in, and the place is being stripped bare. And says, well, I thought all the chattels were included in this. Of course, there was nothing in the agreement of purchase and sale, but the agent is up against the wall because the listing agent did not have in writing that no chattels were included. Okay, and so it's a real important point that when you are listing a business for sale, you either have this stuff in writing or you have in writing why you don't have it. Okay, very important. So what price to list a business at? It's a good question.
وين حبيبي؟ صباح القشطة، ازيك؟
Hang on a second, you guys.
احنا كويسين الحمد لله.
I have to find Victor to quiet him down.
ما عندك خدتها، رحنا عند دكتور العيون اداها حقنة تانية.
There we go. So how do you value the price of a business? How do you do this? This is not a course that,
مش عايز
this is not a course that is going to get into this in a big way. If you want to get into how to value a business, you can look at the commercial courses that are already listed in our YouTube training channel. But let's just look at it simply. Assuming there are financial statements, the simplest way to value a business may be calculated by taking the net income and seeing how many years the payback will be. For example, if the net income is $40,000 per year and the list price is $400,000, then the simple payback is 10 years. Doesn't take rocket science to figure this out. You know, the other way to look at that, of course, is that if you have $400,000 and you're getting $40,000 per year, you're getting a 10% return on the purchase price, assuming an all-cash purchase. If the list price is $20,000 and you have a $40,000 net income, the payback is 5 years, you're getting a 20% return on your investment. So what is that? That's basically capitalization rates, okay? And like I said, this is not a whole course on capitalization rates, but let's just have a quick look. And the reason why it's not a whole course on capitalization rates is that often you can't find a capitalization rate, especially for small mom and pop restaurants. It's just about impossible. Or small bookstores, small shoe stores, you know, anything kind of small, it's hard to do. But for example, franchises or auto mechanic shops, you can find capitalization rates online. You can simply Google capitalization rate for an auto mechanic store as an example. So the value is equal to the net operating income divided by the capitalization rate. So if you have a $40,000 net operating income and the capitalization rate is 4%, the value of your business is $1 million. Okay. In other words, on that $1 million, you're getting 4% return on your investment, which doesn't sound too bad in today's world of 1% savings rates. But back to the example of 400,000 and it's $40,000 per year and $400,000 cost. You have 10 years back, and in other words, you have basically a 10% return every year. 400,000 generates $40,000. The next one back to the top is that if the list price is 200,000 and the payback is 5 years, that's a 20% return. My last sentence on here is cap rate is a measure of return, and probably the most important thing I can try to tell you guys, it's a measure of return and risk. Okay, a 20% cap rate. Wow, that sounds great. It's a 20% return on my investment. That, ladies and gentlemen, is a risky investment. How many people out there today, would be happy with 20%? I'd love to get 20%, but guess what? I am not going to invest in Venezuelan bonds, from Venezuela, because they're too risky. Actually, I think you can get about a 60% return on Venezuelan bonds right now. Sounds fantastic, but you have to realize that it's really risky. The Venezuelan government could crash and your money's gone. Simple as that. So the lower the cap rate, the higher of the value of the company, because the return is less, but the risk is proportionally less as well. Okay. So you have to think about, if you're looking at, in my example, the $200,000 payback in 5 years, wow, that's fantastic. A 20% return on my money. You have to think there's something wrong with that, you guys, okay? Where can you get 20% return on your money? Nothing is guaranteed out there, but a 4% return on your money, you have to realize, is much more realistic in terms of an investment than a 20% return. It brings to my mind, actually, the marijuana business. The returns were unbelievable. You can invest in marijuana businesses and get 35% return on your money. Well, how did that work out for everybody, you guys? I know a lot of people online, looking at the names that are on here, had buyers that wanted to invest in the marijuana business, and virtually none of them worked out. And that's because the risk was too high. The cap rate was too high, okay? So do keep that in mind, please. When you're trying to figure out the price of a business, try to figure out roughly what the capitalization rate and see if it makes sense. If the capitalization rate is, look at it in an easier way. If you have a net income of $40,000 per year and somebody's asking $80,000 for the business, you have a capitalization rate of 50%. I mean, there's something wrong. Number one, if the return was that good, why would the seller sell? Ask yourself that question. Why would the seller sell if the return is so good? So when you see a high cap rate, the return could be good, but the risk is high as well. And so you need to understand that when you're talking to a seller to try to value the business, this is the basics of what you should be able to talk to them about to try to figure out the value of the business. Okay. I know that's a lot. Once again, we go into capitalization rates in a big way in the commercial courses already posted on the YouTube training channel. And of course, you can ask me if you have any questions, send me an email. So chattels and fixtures, we talked about this a few slides ago. But once again, it has to be detailed. You know, there's usually chattels involved. In most agreements, the selling agent should prepare a Schedule C listing all chattels. Sometimes it's C, sometimes it's B, sometimes it's E. You can get all sorts of different schedules. I'm just suggesting a Schedule C because there's A and B already. Statements such as all tables and chairs in a chattel list can cause real problems. I know that last week when we talked about the buyers, the buyer agent should go in and count them all. You could do your job as a listing agent and actually count them all, post the chattel list with the listing as a schedule, and have it all taken care of at the beginning so that there's no questions on what is included and what is not included in the agreement of purchase and sale. Same for fixtures. Whose fixtures are they? Are they going to become the tenants? Are they the landlords? Whose fixtures are these? Shelving tied to the wall, all that kind of stuff. You really have to have a good look around on to figure out what chattels and fixtures there are that may or may not be included in the sale. And as I mentioned earlier, the RICO rules certainly do state that you must have this in writing or a reason why not in writing. The cash business. So cash businesses can be lots of fun, and there's lots of cash businesses out there. Restaurants are notorious for being a cash business. A taxi cab license, another good cash business. A laundromat business, another good cash business. Why do business take cash and they don't report it? Well, it's pretty straightforward, right? I'm sure all of you know they do so to avoid paying tax on that money. It's simple. The downside for the seller by taking cash is that his financial statement stinks because he's only reporting a little bit of what he's making. And so his financial statement, his net operating income, shows a real lack of profit or a tiny bit of profit because he's taking cash, okay? So when you're talking to a seller, when you're trying to list a property, then it's a cash business. The seller has to understand that a bank will not provide a mortgage for a cash business. They will only work off a financial statement. So the cooperating brokerage calls and says, would you send me the financial statement? And you as the listing agent say, of course, but Mr. Cooperating Agent, I want to tell you that he also takes in $30,000 a year in cash. The bank does not care. Now, maybe the buyer believes it and the love factor kicks in and they take the chance, whatever. But your seller needs to understand that they're eliminating a bunch of buyers that may require a mortgage because, or a loan even, because not necessarily a mortgage, of course, but a loan, because a bank will not work on a cash business. That will only go what's written. So if it is a cash business, will the seller take a vendor take back mortgage? Okay. Will the seller hold the paper for the deal? Now, the great part about a seller holding a mortgage from the buyer's perspective is that it means that the seller is putting the money where their mouth is, that there is a cash business. We're valuing this because of all the money I take in, and I'm willing to hold a mortgage for you because I know that this is real, that the cash we take in is real. And so the price I'm asking and the mortgage payments that I'm expecting monthly from you, guess what? I think you can do it because there is the cash business. So it's a pretty easy way to try to sell a cash business is to see if the seller will take a vendor take back. Okay, it makes sense. Sellers generally want to get out of the business. If they do a vendor take back, they're serious because you know what? They don't want the business back. Plus, Mr. Buyer, you might wreck the business. And so if I do have to take it back, then I may not have a business anymore. And so, you know, in general, sellers that take a vendor take back for a business, they are pretty sure that the buyer can make a go of it, even in a cash business, to be able to pay the monthly mortgage payments or whatever the setup is for the mortgage, okay? Another choice, number 3, it's a cash business. Will the seller allow a buyer to sit, for example, and I'm just saying an example, 10 business days, to see the cash that is taken in? I have seen this a few times now in hair salons. Hair salons is another, pretty good cash business. And I know that there was one, I think it was at least 20 business days that the buyer could sit in there and see what kind of money was actually being put into the owner's pockets without being reported to the government. Okay. Is that totally safe and kosher and all that? Well, there's arguments here and there for it, but there's actually a clause in web forms that covers this possibility that a buyer can sit and watch what's going on in the business. And so this is a way also that if the seller knows in advance in a cash business that this may happen, then it may facilitate a smooth transition and a good sale. Okay. Can the seller at least show some sort of proof of the cash amount? This is difficult. Number 4 is difficult here for sure. I mean, can sellers show their own personal bank account statement where a bunch of cash is being dumped in there on a weekly basis? Haven't seen too many sellers do that. I've seen one, to be honest with you guys, that did do that and it made the sale happen. I've never seen another seller do that, but I thought I'd add that in there in case there's something I haven't thought of, some sort of proof of the cash amount. The only one I can think of is a personal bank account that they're putting cash in there. I don't know what else would really, really work, unless, of course, the net operating income shows 0 and you go to the seller's house and he lives in a mansion and he tells you it's a cash business, and then so maybe he's doing very well. But that's the only other one I can kind of think so. So you should discuss these with a seller of a cash business to help facilitate a buyer's requirements. So in a cash business, mortgages aren't going to happen. The best one really is number 2. Will the seller take a vendor take back? That often will work. So commissions. How much commission to charge is dependent on the ease of the sale. Restaurants, as an example, are very difficult to sell today. Why? Well, because their income statements for the last 12 months stink, right? I mean, they can't be good. There's not very many of them that would be good after the last 12 months. My goodness, almost 2 years now, closing in on it. And so it's pretty hard to sell. So excuse my writing here. This should say a minimum. Didn't catch that. But don't be going into these places that, like a residential house that's easy to sell at 3.5%. These are difficult to sell. 6 minimum, 7, 8%. You're going to have it listed for a long time. You're going to field a lot of questions. You want at least a 6-month listing for a restaurant. Now, it depends on the speed of the sale. How easy is it? I mean, if your financial statements are showing $10,000 and the seller wants $2 million, well, I think I'd probably walk away. But if you wanted to do it, make sure that you're charging them at least 10% and you have a listing for at least a year, so that you have a chance of getting this thing sold if the sellers are being unrealistic. Okay. A Tim Hortons is going to sell a lot faster than a taco stand on the side of the road, if you know what I mean. A Tim Hortons, is going to probably go fast. Tim Hortons might be a bad example because they're generally all in-house sales. They're not out in the open market. Maybe a Subway is a better example that come into the open market. But, maybe a Subway in a great location with a really good financial and income statements, maybe you would do that at 5%, or maybe even 4.5 or 4, right? Because that, wow, I've got a really great sale here. It's going to go really, really fast, almost like a residential house kind of thing that's listed at a reasonable price. And you have to kind of make a judgment call on that. I cannot tell you a hard and fast rule on commissions and listings, a length of time of listings for each one, because everything is kind of individual at this point. There's no hard and fast rule for what commissions you should charge, but you should look very, very closely at the asking price, the location, and the net operating income, and say to yourself, geez, would I buy this myself for this price? And if you say no, then you better increase your commissions and you better increase the length of time that you're going to do this listing for, okay? Appointments, of course, you have to discuss this with your sellers. Can a buyer visit anytime? Or if not, what times, right? You should have this in your brokerage remarks on your MLS listing. Can a buyer speak with the employees? There's lots of listings out there right now that says very clearly in brokerage remarks, do not speak with the employees, okay? Is there a lockbox? Or where is a key after hours? Okay, so lots of businesses don't want a lockbox on their front door. Why? Because it shows that the property is for sale, okay? Where is a key for after hours? And so you need to talk to the you need to talk to the seller about this stuff. And, sometimes the listing agent has to be present for all showings. Maybe if that's the case, you want to charge a slightly higher commission because it's going to take time out of your day, okay? Whatever is happening here, these items must all be clear in your remarks for brokerages. It's really quite simple. Advertising. Does the seller want a for sale sign? There's not too many restaurants that I know of that want a for sale sign in the window unless they're basically closed, because it kind of turns customers off. If there's a for sale sign, God, how good is the cook in here if the property's for sale, What about the pictures? What pictures are you allowed to take? Do they want to be on MLS or is this an exclusive listing? Of course, that's pretty straightforward. What about advertising online, social media, your website, that kind of thing? You do have to be careful. Some people do not want it greatly known that their place is for sale, which of course makes your job 10 times harder. I mean, it's much easier if it's on MLS. You can put a sale sign in the window. You can advertise online, social media, websites. You can do all that kind of stuff. That would be wonderful. But some sellers don't want that. Okay, they don't want to hurt what they feel is a perception. And many times it's true that by advertising that it's for sale, that there's something wrong with the business and it turns customers off. That is certainly true in the restaurant business, and understandably so. And so you do want to have a good discussion with your seller. The listing agreement in section 5 is the marketing. That basically in section 5 of the listing agreement, you have the right as the listing salesperson to do whatever you want to market it, okay? If they don't want a for sale sign, as an example, you should cross that portion out of section 5 and have the seller initial beside it that you're both on the same page, that there's no for sale sign. And we'll go into the listing agreement in a few minutes and have a look. Inventory. We talked about inventory last week to some degree. And you, of course, have to talk to your seller about how to handle inventory, okay? Is there inventory, of course, is one question. And then inventory that will be left is agreed upon as part of the negotiations and is included in the purchase price. That's one choice. Inventory will be left up to a certain dollar amount as indicated on Form 502, which is the agreement of purchase and sale for a business in a leased premises, and we'll have a look at that. Or inventory will be counted the day before, and the buyer is responsible for what is counted no matter what the value, okay? I mentioned this last week too. There are professional companies out there that all they do is specialize in counting inventory. So you can hire a third-party accounter, I guess, and that party will come in the day before and count all the inventory so that you know it's the accurate amount. We have had this problem at the bottom. In all cases, inventory should be the wholesale price, what the seller paid, not the retail price. Be sure the seller understands this. Nothing like a seller who thinks he's going to be paid the profit on every case of Coke that he's got in the back room, And so it's the wholesale price that a buyer will pay. And the typical inventory clauses in web forms do say that it is the wholesale price, not the retail price. So make sure your seller understands that he's not going to make any money from any leftover inventory when the buyer buys, unless there's some kind of other arrangement, I would imagine, but I don't know too many buyers that want to pay retail price for inventory. in a property, I'm sorry, for a business, just doesn't make sense to me. Okay, so the most common one is 2 or 3, and number 4 is more of a pretty big kind of store or big restaurant kind of thing. A hardware store is one that I was involved with, where we had to get inventory counted by a professional counting company. Because, what about all the screws and nuts and bolts in a hardware store? You can just imagine gets a little bit out of control. So you have the professionals come in, and we'll have a look at Form 502 in just a few minutes here. So you definitely need to discuss with your seller on the inventory. 2 other things that you need to talk about: taxes, capital gains, and the next one is depreciation tax. And so you need to talk to your seller about this, folks. In most cases, if there is a profit when a business sells, the seller will have to pay capital gains. Okay. Now I have to qualify this because I put in not exact. Okay. So you can't take this as verbatim that this is exactly the way it works. Okay. You can't say John told me it's like this, because I put in brackets here a not exact capital gains illustration. Okay. But basically, this is the way it works. The profit. So you get profit. Total profit is minus capital expenditures, okay? And capital expenditures, real estate, and closing costs, so that you come up with a net profit. So your total profit of the sale for the seller is, let's say, $150,000. You probably don't have any capital expenditures. Why? Because you're leasing. This is the sale of a business in a leased premises. You probably are not adding a lot of stuff to the leased premises. That would be the landlord that's adding all this stuff. But maybe you've put in a wall, that kind of thing. That would be a good expense out of capital expenditures. But in this example, I've shown 0 capital expenditures. Real estate commissions, $20,000. Closing costs, $10,000, just as an example. So the seller has $120,000 net profit after capital expenditures, real estate, and closing costs. Capital gains tax is calculated on 50% of the net profit. In this example, $60,000. So we've divided the 120,000 by 2, 50%, 60,000. The tax amount is based upon the seller's marginal income tax rate. Now, the example I'm using is 30%. I think most of you probably know this, but the Canadian government, Ontario Canadian government combined, have marginal income tax rates. I think right now the lowest income tax rate, and anybody can correct me on this, it doesn't matter. I think it's 19%, and then it goes 23, 27, 32, 37, 41, 43, 47%. And so it depends on the seller's marginal income tax rate, okay? So if the seller is making tons of money somewhere else, and he's got a marginal income tax rate of 47%, he's gonna pay 60,000 times 47% in capital gains tax. In the example I'm giving you here, the seller will pay $60,000 times 30% as their marginal income tax rate. So they're going to pay $18,000 capital gains on a net profit of $120,000. Okay, that's capital gains. It's pretty straightforward. Basically it's the net profit after closing costs, real estate, and any capital expenditures, which would once again be pretty rare, but they could happen. And then it's 50% to calculate what's taxable. And then that taxable amount is multiplied by the marginal income tax rate. Okay. You don't want to get into any more detail than this when it comes to capital gains. There's other little things. And if you're big corporations, there's capital gains exemptions, all sorts of things that you can do with capital gains to try to lower it a bit. But that's up to your accountant. You must inform the seller to check with their lawyer or accountant. Don't hold yourself out as an expert in capital gains. You're a real estate agent. You're not an accountant or a lawyer. So should you have a chat with your seller about capital gains? Yeah, of course you should. Hey, Mr. Seller, you're selling this. Are you going to make a profit on this? Oh, yeah. Are you aware, Mr. Seller, that your profit is subject to capital gains? And if they go, yes, well, great, hooray. If they say no, what's capital gains? This is what you could rough in for them. But at the bottom line is you must direct them to their accountant, and even to the point where, a seller's lawyer's review condition in the agreement of purchase and sale, the seller's lawyer is going to tell them about it. So protect yourself. Do not hold yourself out as a capital gains expert. So the other tax that you need to talk to a seller about is recapture tax. What is recapture tax? Recapture tax is what a seller will pay for taxes on the difference between what equipment or chattels have been depreciated to and what amount the value of such items is decided upon. So you have a stove, okay? The stove is depreciated for tax purposes to $100. In this example here, we'll just say that the seller bought the stove for $1,000, okay? And every year for the last 9 years, they've depreciated the value of that stove. Why would somebody do that? Because when you have a depreciated value, you can take that away from your income for tax purposes, okay? So if we've depreciated the stove in year 1 by $100, we can subtract that $100 from our income and not pay tax on that $100, okay? So this is a common way to reduce taxable amounts that businesses have to pay. They reduce the value of their equipment or chattels or buildings so that they can reduce their taxable income. Okay, it's very, very common. So in this example here, a stove is depreciated for tax purposes to $100. The buyer and seller agree that the value of the stove is $400, and they write that into the agreement. The seller will have to pay recapture tax on $300 at their marginal income tax rate, because what they have done is they've depreciated it for tax purposes to $100, and they've had a tax advantage now for the difference between $400 and $100, and so they now have to pay tax back that they saved. They now have to pay it back on that $300, okay? So back to Bob's question, can you do a share sale without listing all the assets or giving the value of the assets? The answer is sure, but will a buyer accept it? You need a really good tax accountant there, Bob, because can the buyer self-declare what the value of the chattels are? Well, sure, but guess what's going to happen? The CRA is going to go to the seller and look at the seller's income statements and find out what is on those income statements in terms of depreciation, and the seller is going to have to pay recapture tax. So it doesn't make sense, okay? I hope that helps. So, recapture tax. Does anybody have any questions on this? I know it's not easy, especially if you've never dealt with capital cost allowances before and depreciated values, but this is something that when you're selling a business, that you need to know. You need to know about recapture tax, okay? So that you can tell the seller when you get an offer in on the property that has the value of the assets as $400 and you've depreciated it to $100, that the seller is now going to have to pay tax. Well, maybe the seller now wants to ask more money for the business because of the tax he's now going to have to pay on $300 in this example. And this becomes a real negotiation, okay? Why does the buyer want to have the value of the stove at $400 instead of $100? And the answer is, the buyer can then depreciate the stove starting at $400 so that he reduces his taxable income. If he starts at $100, obviously he can't depreciate it fast enough to make a real impact on his taxable income. So once again, you do not need to be an expert on capital gains or recapture tax. You're not experts. You're supposed to be an expert in real estate, not capital gains or recapture tax. But does your seller need to be aware of this? In some cases, absolutely, for sure. Okay. People do depreciate. I ran a business. I had lots of chattels in my business, lots of equipment. I wrote all sorts of stuff down. And when I sold it, I had to pay recapture tax. Okay. I knew that going in and I knew that coming out that I had to do it. So I was fine. But you don't want a seller to be surprised that there's recapture tax in there. Always refer your seller to an accountant or a lawyer, please. Or once again, make sure that you have a seller's lawyer's review of the terms herein so that there's no question that that your seller understands. Many offers will contain a clause that looks similar to this, that the seller will give a proposed allocation of price regarding fixtures, chattels, and equipment, goodwill, trade name, and leasehold improvements. Okay. Why does a buyer ask for this? The buyer asks for this for the exact same reason. They want to see what things have been depreciated to. What is the value of these things on paper? This is what the government looks for. Okay. The buyer is going to be able to the buyer is going to be able to reduce their taxes by the book value, depreciated by the book value of this equipment. Okay. If the book value is really low, then the buyer cannot take advantage of this. It's as simple as that. Okay. HST, another wonderful tax. The seller is responsible for the payment of HST, if any. Okay. The buyer is not responsible. What does it say? It says in an agreement of purchase and sale on the residential that your tax is included in or it's in addition to. So what most real estate agents think is that the buyer is responsible for paying the tax. That is not true. When tax is in addition to, the buyer is responsible to pay the tax to the seller, and the seller has to pay the HST. Okay. When a seller is selling a property, there should be sure that the buyer is also an HST registrant. If the buyer is an HST registrant, the taxes simply flow through without cash having to exchange hands. I know I'm looking at the list of names here on who's on this Zoom with me, and I think most of you know what this is and what this means. You are all HST registrants. As a real estate agent, you're HST registrants. When you're an HST registrant, you have to pay the HST on your commissions to the Canadian government, minus your input tax credits. If a buyer buys a property and the Canadian government would not allow it to flow through, then the buyer would pay the HST to the seller would pay the HST to the government, and guess what would happen? The buyer could claim the money back as an input tax credit. Why go through all that paperwork? We don't need to. The government lets the taxes flow through on paper without cash having to exchange hands. Okay? So both buyer and seller should be HST registrants if the seller is an HST registrant. Do not put any HST clauses in Schedule A that will override the pre-printed clause without management approval. Okay. Form 502, which is the agreement of purchase and sale for a business in a leased premises, paragraph 3 or 4, I think it's 3, has it all pre-written in there already about HST. Don't put anything else in Schedule A because anything in Schedule A overrides the pre-printed portion of an agreement of purchase and sale. Does anybody have any question about HST? So those are the 3 taxes, you guys: capital gains, recapture tax, and HST. Everybody here should be familiar with those 3 taxes. You don't have to be an expert. You need to know about them. and then always refer to an accountant or a lawyer. The lease, moving away from taxes, such a nice dry subject, those taxes, wow. The lease, will the buyer assume the existing lease or will the buyer negotiate a new lease? Does the landlord have to approve the new tenant? Very often. Can the seller just sublease as per the original lease? Is there a line in the original lease that says that the seller can sublease? End of story. Who knows? Every lease is different. As a seller agent, you really need to see the lease. You really need to have a look at the lease. Most buyers will want to review it anyways. Most cooperating agents are going to ask you all sorts of questions about the lease, such as how many years are there left? Is there a renewal period? Can we just get it assigned to the new buyer as a sublease? Do we need landlord approval? You really need to see the lease. Now, some leases, unfortunately, are 35 pages long, and it's difficult reading. But you know what? I can advise you, please have a read. See what's in these leases. Some of them are complicated. Some of them are very simple. If you're in a place like the Eaton Center or the Yorkdale Mall, the lease is complicated, okay? If you're in a little plaza somewhere, the lease is probably not complicated. But some big property management, the leases are 35, 45 pages long. And so you need to have a look at it and see what it says, because the cooperating broker wants to know what's in it. Okay, so you need to ask these questions from your seller. What's going on? Let's have a look at the following forms. So here's your confidentiality agreement, form 560. And you can see here that it's between the seller, the buyer, the landlord, the tenant, and the brokerage, or the brokerage, to the seller, buyer, landlord, tenant, brokerage, advisor, other, whoever, concerning the property known as, and described as the financial information, the net operating income, whatever, for this property, and that this agreement authorizes the recipient to share the confidential information with a lawyer. Sometimes they want the lawyer's name and address. The accountant, sometimes they want the accountant's name and address. And this is your standard confidentiality agreement. There are many other confidentiality agreements out there, okay? At Century 21 Heritage Group, we have our own in-house confidentiality agreement that's 4 or 5 pages long that will tie everybody together. We'll tie the seller, the buyer, the cooperating brokerage, the listing brokerage, the lawyers and accountants all together in one document. It's not used very often, but it is out there if you need it. Might make your life a little easier sometimes. But this is the standard non-disclosure agreement. They call them NDAs in the commercial business, a non-disclosure agreement, a confidentiality agreement, the same thing, okay? Form 816, you guys are working as a commercial agent. If you're working as a commercial agent, you need people to sign the working with a commercial realtor as opposed to the residential one where it just says working with a realtor. It basically says the same things as the other normal working with a realtor. The only difference here, it says commercial, but it goes on to explain a client and a customer and what happens with multiple representation, that kind of thing. And of course, the signatures are the same, but don't use the regular working with a realtor when you're doing a commercial deal. Use Form 816, please. The listing agreement commercial, very straightforward. Not a big difference here between the listing agreement as opposed to the residential agreement. It goes on a little bit more about holdover periods, a little bit more about multiple representations than the residential one, but essentially same thing, you guys. Privacy Act is different because of the business part of it, a little bit longer, so you get 4 pages, 3.5 pages really, more so than you do in the residential, but essentially it's the same. And here's what we talked about earlier, paragraph 5. The seller agrees to allow the listing broker to show and permit prospective buyers to fully inspect the property during reasonable hours. And the seller gives the brokerage the sole and exclusive rights to place for sale and sold signs on the property. Well, if the seller doesn't want a for sale sign, you should cross this out and have the seller initial beside this, that they understand that there won't be a for sale sign. Okay. Can we do all advertising decisions relating to the marketing of this property during the listing period? It has the listing brokerage has the sole and exclusive authority. If they don't want this on a website or something like that, then you should read this over with your seller client and make sure that you're crossing out the parts that do not apply and have the seller initial. The worst thing in the world that can happen to you is that you agree verbally that you're not going to put a for sale sign in, and then he calls you 3 weeks later and says, "Where's my for sale sign? How come you haven't put it up? You're not doing my job." And then you can go back and say, "Well, wait a second, we initialed that, okay, that you didn't want one. Would you like to change that now?" Okay, and then you can change it and have them initial it. Okay, so do make yourself familiar with it. Okay, same as the residential one, it's virtually the same. Okay. AREA Form 590. AREA Form 590 is the commercial sale MLS data information form. Now, we're talking about the sale of a business in a leased premises. Why do you need an assessment roll number? I don't know. But you're just going to put down the property where it's located, the assessment roll number. We know it's not for sale. The rest of this is pretty straightforward on the first page. If you have a lot frontage and a lot depth, you don't necessarily need it for the sale of a business, okay? The list price code. And what I'm going to do now is I'm going to go to the very bottom here for a second and show you here on the bottom of the back or the bottom, whatever, it has price codes. It also has details and descriptions for all commercial property types. And you can see all these numbers here, 2, 3, 4, 5, 6, 7, 8, 9. It goes quite high, actually. Goes up to number 26, okay? And what I want to show you here, and I get asked this question all the time, is we're here and we're doing the sale of a business without property. And it is for a delicatessen, and you check this off, okay? Commercial retail property, do not use for sale of business. This is sale of a business, okay, that we're talking about, and you tick off whichever one it is, and I think it's got pretty much everything covered, okay? You have other choices here as well, depending what you're doing, but we're talking about a sale of a business here. And then it comes down to here, and you can see the notes. There is number 4, total area code. So let's go down to the bottom of the document and look up number 4. And it says total land building area. It is mandatory for commercial, retail, farm, industrial, investment, land, office, store with apartment. It is optional for the sale of a business. So you don't have to put it in if you don't want to, okay? If we take a look at elevator, number, it's so small, 16. Let's go down to number 16. Number 16, elevators, mandatory if it's an office. It's optional to enter this if it's a sale of a business. You've always been taught on your MLS data sheets that anything's in color, in this case, brown, 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 right? You have to answer these. But because of these little numbers, you don't have to answer them all. Truck level shipping doors, number 15. Number 15, mandatory for industrial, which makes sense that we want to know what the door level is, what's the height of the door, but it's optional for the sale of a business. So you don't, maybe your business doesn't have it. If it has it, to get shipping into the back, maybe that's a handy thing to put in. But that's what I wanted to show you here on this form, is all these little numbers and when they are necessary to put in and when they are not put in, okay? The rest of the form, really, it's pretty straightforward. It's not hard to figure out at all. just always refer to the numbers and where it's optional and where it's not optional to put in, depending on, we're talking about, once again, the sale of a business, but maybe just as an aside from this little lesson that we're going through here, maybe you're trying to do a commercial retail property for sale. Well, what is it? Where is it? That's different. Maybe you're selling a farm, that's different. Maybe it's commercial land, that's fine. And then you go through this stuff the same way, and you always refer it down to the last page or on the back if you're using the paper, and you refer it to these numbers here. And lastly, just as a reminder to you, if you're selling a business, it's probably in a corporation name. If it's in a corporation name, you have to use form 631 as opposed to 630. 630 is the individual identification record. 631 is the corporation identification record. You need to see the articles of incorporation of the business to make sure that whoever is signing for the business has the right to bind the corporation. So as a selling agent, we're assuming that you get an offer. So what clauses should you look for? What should you be careful about in an agreement of purchase and sale for the sale of a business? Often, very often, one of the clauses in an agreement of purchase and sale for the sale of a business is that the buyer needs to change their name somewhere down the line. Okay, maybe they're going to start a new corporation. Maybe the existing buyer is just an individual and one day they need a corporation. Or maybe they've got a really good idea and they know a buyer and they want to sell the contract to the buyer. Okay. Assignment or a change of name clause. Be sure that the original buyer named herein shall remain responsible for the completion of the agreement. Okay. There's a couple of clauses out there that says that the buyer can assign or change the name of the buyer in this agreement. And then it goes on to say that the buyer named herein shall be released from this agreement. Well, wait a second. You're protecting your seller here. You don't want a buyer to assign this to somebody who has no money and then it doesn't close. Okay. So the original buyer named herein should remain responsible for the completion of the agreement. Okay. Protect your seller. All right. Be sure there is a condition for the seller's lawyer and or an accountant to review. We've talked about this a few times now. I can't stress it enough. It's really important that you have the terms of the agreement reviewed by the seller's lawyer and or the accountant. Is it clear? Number 3, is it clear on what the buyer is going to do with the lease? Are they going to try to negotiate a new lease? Are they going to try to assume the existing lease? This has to be written clearly in Schedule A on what is going on, okay? It can't be a maybe situation out there. I've seen offers with it maybe, and you can just see that just blows up in everybody's faces. Well, I thought I was going to just take over the lease. Well, the seller said that I thought it was going to be a new lease with the landlord, and the landlord thinks there's going to be a new lease. And you can just imagine the roundabout that kind of a conversation will have. Make sure to protect your seller, that everybody knows what's going to happen with the lease. Do you need a landlord's approval condition for the new buyer? You need to talk to your seller. Maybe you even need to talk to the landlord, okay? And say, let me talk to the landlord, Mr. Seller. I just have a few questions for him. Or do you know these following answers? You know, is there something in the existing lease that says it must be with the landlord's approval? Now, sometimes it says it must be with the landlord's approval. Sometimes it says it must be with the landlord's approval, which approval shall not be unreasonably withheld. Okay. So, you know, do you need this? You need to talk to your seller about this so that you're getting this right in the offer. In commercial deals, try to avoid, this is number 5, Try to avoid conditions that have deadlines of 50 business days. This offer is conditional for 50 days following acceptance of this agreement of purchase and sale on the following conditions. Don't do that, all right? If there are long conditions, put in a time and a date, okay? Then everybody knows that 5 p.m. on November 30th, the condition is expiring. And I can give you a few examples of problems when you have 50 days. One of them is Good Friday. All right, is Good Friday a banking day, a business day? Is it in Ontario? Where is it exactly? And are the banks open? Are some banks open? Who knows? And the latest one was the September 30th, the new reconciliation federal holiday. Is that a date that banks are open? No. But is it a statutory holiday in Ontario? No. And so these things can really screw up a deal if you've got lots of business days in there. Who wants to sit there with your calendar and a pen and go 1, 2, 3, 4, 5, 6, 7, 8? If you need 50 days, you need 10 weeks. For goodness sake, put in a condition that ends in 5 p.m. 2 months from today, and make your life easy and make your buyer understand it. The seller understands it. The cooperating agent understands it's no question on when the dates should be firm. And as a matter of fact, folks, even in your residential deals, 5 business days following, if you're running into Good Friday and Easter Monday and or the Truth and Reconciliation Day on September 30th, we had huge arguments on September 30th on whether to take an offer that was ending, or sorry, a condition, I should say, that was ending. Put in a time and a date. It makes everything so much simpler, whether it's commercial or residential. Of course, you need that proposed allocation of price regarding fixtures, chattels, equipment. Look out for this. Buyers are going to put this in. They're going to want to know. And that's when you can talk to your seller about recapture tax, okay? Most deals will have this line in there, so watch out for it. Be careful for any clauses regarding signage or parking. Are they accurate? This sale of this business includes 5 exclusive parking spots. Is that true? Did the buyer agent just follow what the buyer said? I want 5 exclusive spots. Are the spots actually there? Signage, can a buyer actually put a sign up where they want a sign? Are they assuming that they can get onto the pylon at the side of the street? You know, the tall signage on the side of the street, the pylon. And, you know, don't assume just because the buyer's in there that that it's correct. Make sure, okay? Number 8, and this could be the trickiest. Be careful with seller's representation and warranties. Clause C519, we talked about it last week. C519 has 19 sections in it. The seller represents and warrants that. Okay, that means it has to be. Okay, read carefully, please. One of them says the seller will stay on for training classes. Does your seller know that he's signing that he's staying on for training classes for 40 days? Maybe the seller's not so happy about that. Maybe he's not happy to stay there for 1 day. Be careful with sellers' representations and warranties. Buyers will put a lot of them in because they're protecting the buyer. Is the seller aware that representations and warranties means that the seller is saying that it is true? Be careful. Number 9, be sure that any transfer of licenses, franchise agreements, or LCBO clauses are accurate. All right, especially when it comes to franchise agreements. I have to tell you, boy, I've seen some deals where it's 120 business days for the franchise agreement to be transferred to the new buyer. Who wants to count 120 business days? For goodness sake, put down 4 months from now and put down a date and a time, okay? But make sure that they are accurate, and make sure that the seller has the right to sell the franchise, has the right to transfer a license, has the right to transfer an LC. Well, you don't actually transfer an LCBO license. You kind of give it up and it's new to the new buyer. But a great question to ask a seller that has an LCBO license: have you had any problems with your license? Because if there's problems with the license, there'll be a mark somewhere in the Liquor Control Board offices that there's something wrong. And can a buyer actually take it over? Maybe they don't like the location. Maybe it's going to be suspended, the LCBO one, because of infractions. Be careful. You've got to read what a buyer is sending you. Number 10, is there a landlord's lease that must be completed? And I think we've talked about that enough, about some of those things about landlord leases.
Thank you so much for watching. If you like our video, please hit the like button, the subscribe, and even the little bell to get notifications, just so you can stay in touch and watch more of these great videos.